In this portfolio update video, I'm going to talk about why I don't invest in US stocks or foreign equities for the current time being. I'd also like to make a comment on the recent news regarding Brexit and the negotiations, and as always, talk about how the portfolio has performed in the last week. So the stock market is closed for trading, and there is a bank holiday on the Monday. So we have got a longer weekend to just take some time out away from the high volatility, just to relax and review our portfolios and potentially change our allocations. And as usual, we've seen some high volatility in the last week. We've seen both a rally and also a retreat. I went from being about £200 in the green on Tuesday to about £20 in the red today. And this is mainly due to the fact that I have no longer continued averaging into my investments of Shell, Aviva and Legal & General. And this is because they are still great investments to average on, but I've now changed my mind, my vision. I want to expand on some of my other allocations. I want to reduce my overall allocation to energy and then move on to other individual stocks and diversify the sectors further. And those stocks are still great value stocks, but I want to follow more of a different strategy, similar to like what Warren Buffett does, where he buys wonderful companies at fair prices rather than buying fair companies at wonderful prices. Initially, I was looking for all the value I could find and then buying these mediocre companies at a really good price, when in reality, a fair priced, wonderful company would do better in the long term. This week, we've actually seen a rally of mining stocks, and they were one of the things that held up the FTSE 100 and 250. And luckily, I am exposed to that sector through the fact of diversification, so that I didn't miss out on those gains. However, do bear in mind that I'm not exposed to telecom, so if that does have a rally, then yes, I've missed out on that. You'll also notice that I've started two new positions, one with GlaxoSmithKline and one with Tesco. Currently, they only have one share each, so they're not really positions per se, but they are there so that I can average into in the future. But as I said, I'd like to bump up my allocation with other stocks first. And Tesco actually are planning on selling their Thailand and Malaysian stores, and then reinvesting that money into their shareholders by doing a special dividend. So I would like to get onto Tesco and bump up my allocation in the short to medium term, but I do have other priorities first. And likely with this, we might be seeing quite a high yield of like 25 to 30%. Although, as you can see, investors have priced in the fact that this won't happen by a considerable drop since their ex-dividend date. Although for the time being, I'm going to build up my cash position, which is only currently sitting on £50. I do have money on the side that I will plan to chuck into my portfolio should some of these stocks reach new lows or fair value prices, in which case I'm going to extremely bump up my allocation, and then you're going to see some weird diversification per se. And I do have about 6 to 7 companies in mind on what I want on my top spots, some varyingly different from what I have currently, and some of the ones on the top spots will remain and some will even get bumped down. Like as I said, I want to reduce my exposure to energy. I'm not going to average any further into the energy stocks, but I am going to leave it as that. If it rises up, I might sell out at to take some profit from the investments too. I haven't decided yet, and it's simply speculation at the moment. But as I said, I will look to deposit lump sums if I see stocks like Redrow trade at a discount and Sage. Sage is currently my position with the lowest allocation, or one of the lowest allocations in my portfolio, so it may be a surprise that I'm thinking about this. And if I see it go below around £6, £6.20, that's when I'm really going to bump up my allocation, as I think it is a wonderful company that's trading just a bit over fair price. I could buy it now, but I would like some more gains from it, so I'm quite greedy. So we have actually earned 2 dividends throughout this week. We haven't been paid any dividends yet, and I think we've earned a total of 7 or 8, but I believe they're all going to be scheduled for June, so we're just going to get a sudden influx of dividends. I don't expect these two to be high. One was Tesco, which I had 1 share in, so that's going to be like 4 pence or something, and the other one's Sage, which might be 50 pence. It's a 2.5% yield, it's a £50 stock, I don't know, but it's not going to be a considerable amount, but it is nice to see that we will be getting some dividend income soon. I'd also really love to hear how your investments have gone this week, and have you bought any more stocks for your portfolios? Please tell me by leaving some comments down below, and I'll make sure I'll read them and respond to you. Also, in recent news, one of the larger dividend payers with a very strong growth rate has cut their dividend. This company is Imperial Brands. They were growing their dividend year on year by an average of about 10 to 11%. So it is quite a surprise to see this happen. I was actually considering adding them to my portfolio at one point, but I deemed deemed the yield to be too risky. And I suppose I was right, because they did eventually cut their dividend. And I think if we take something from this, it goes to show that no dividend is safe, only some are less risky than others. If you've enjoyed the video so far, please consider subscribing for monthly stock picks to watch or to buy and weekly portfolio updates. So click that button down below. Thank you. So to the main part of the video about why I don't invest in US stocks. As people have pointed out in the comments, and you can very likely see, I don't have any exposure to any foreign equities at the moment, and in fact all of my stocks are UK listed. That's different to many other investor channels in this niche. They typically have more US stocks than UK stocks, and that's from UK investors too. And just because I don't hold them per se, it doesn't make it a bad investment to have. But I do have my reasons, and firstly, I like to use an ISA, an individual savings account, which is exempt from tax in the UK. This means that I'm not going to be taxed on most of my investments, but it does mean if I invest in American stocks, they have a withholding tax of 15%, and I will still be paying that. So why would I cut 15% of my potential dividend income when I could invest tax-free in the UK? And most American stocks pay quarterly, so I'm going to be seeing that reduction very often. And 15% could mean a lot to the future compounding of my portfolio. And UK stocks clearly don't have this issue because they are tax exempt, because you paid tax on the money before depositing it in your ISA. And as I'm a tax resident, I am exempt from UK taxes except stamp duty. Freetrade, my current broker platform, also charges higher fees than its competitors for US equities. This means that if I've got a dividend income in dollars, the currency conversion will be the spot rate, 0.45% is added on as a fee, which means I'm also losing out even more on my dividend income. Whilst this could be very advantageous if the pound continues to weaken and the dollar continues to strengthen against it, I don't think this will continue to be the trend in the medium to the long term. And with the recent news about the government not delaying Brexit talks and negotiations, and they're not delaying it to a later point, a lot of investors have become uncertain. However, I believe this is to create pressure on Europe to accept an incoming deal as the deadline will be running out. As yes, the trade agreement would be a detriment to the UK, but it also would be a negative impact to Europe. And this is very similar to how the oil price war started at the same time as the pandemic crisis. I believe that we are making advantage of this pandemic crisis and using it in a form of negotiation and arbitration with Europe. Now, if I make some very broad assumptions and assume that most politicians likely have some form of investments in their name, such as a pension plan, or maybe they have their own ISA, they would stand to benefit from further drops in stocks. But if we delay the Brexit negotiations, such as the suggested time period of another 2 years, we're going to see our stocks continue to drop as it is priced in for the next 2 years, like we've seen already for the last 4 years. And I simply think that the fear it creates by not accepting this allows stocks to be priced in lower, so these people could get a better return on investment by buying in now and then getting this Brexit deal done. Potentially, if it's a soft deal, and I'm speculating here, the economy could benefit greatly from this, and then we'll see a trend in the stock market where we rally considerably. If you couldn't already tell, I'm very bullish on Brexit and the outcome for the UK. It may be naive, but I believe that investors have already priced in the fact of a bad Brexit deal, the pandemic crisis and having a second wave, the oil price war. It's all priced into the market right now in UK stocks, which leads to very high value. And my current investment plan is heavily weighted on a Brexit play. I stand to gain a lot if Brexit works out in the UK's favour and we do see a significant rally in stocks. But I also think there's little to no risk on it. We've seen so much pricing on the market, I don't think it would be reasonable to say that we could drop another 50%. I think it's already been priced in. Yes, we could see probably a drop of 20 to 30% if there's a hard deal. I don't see it going much further than that. So I'm seeing low risk compared to an extremely high reward outcome. And in perspective, I think there's relatively no risk compared to when the EU referendum for Brexit had first occurred. And this may be a difficult path for the UK, but I would like to maximise my potential gains with this opportunity and hopefully in the long run making more from it. Worst comes worst, I lose my money and I start investing again. I've got a lot of years of investment opportunity in the future, so I would like to take advantage of this high risk play and see how it works out. And that's also why I've started to reallocate my current positions. You're going to see a greater exposure from my portfolio to FTSE 250 stocks, and this is because I think they will benefit the greatest if we do come out of Brexit with a strong soft deal. And one of the reasons why Red Row is my current highest position, and I plan to put more into it. Currently, I think the pound will once again rally up to its original amount, and if I had investments in foreign currency, I would lose considerable value. So I'm going to be patient and hold off with the currency risk for the time being. However, if the pound does stabilise, stays low, we have a bad deal with Brexit, then I will look to investing in foreign equities such as Roche. And make sure to stay tuned, as coming this week I'm uploading my dividend stock picks to watch and to buy for June 2020. As well as in my next portfolio update next week on Saturday, I'm going to talk about the importance of bonds in a dividend portfolio. Thank you for watching. I'm Osborne Foreman. Have a great night.